Good morning and welcome to Wellington's first half result conference call. I'm Howard Milliner, Wellington's CFO. You probably have read the company's interim report, which was released on 26 August. I'll be providing comments on the result for the 6 months and on our expectations for the rest of the year. Greg Allen will then update you on the significant progress we've made with the launch of our new products. I must start with the usual warning. We'll be making forward-looking statements on the call today, and as these are predictive in nature, they're subject to a number of risks and uncertainties relating to Wellington, its operations, the market in which it competes and other factors, some of which are beyond the control of Wellington. Actual results and conditions may differ materially from those expressed or implied by such forward-looking statements. The result for the 6 months was an EBITDA profit of $12,000 on revenue of $13.5 million. The result for the same period last year was an EBITDA loss of $2 million on revenue of $10.6 million. The lower New Zealand dollar-US dollar rate clearly helped us, 0.75 on average through the period, compared with 0.84 for the first half last year. But most of the key metrics showed significant improvement. We sold 15% more motors, generated 14.5% more US dollar revenue, increased gross margin by 2.2%, and reduced operating expenses by 15.6%. To expand a bit more on these trends, 602 refrigeration motors were sold in the 6 months, compared with 524 last year. EC motor sales actually increased by 29%. Shaded pole motor sales declined. Revenue from Latin America was US $7.2 million, a 47% increase, half over half. We saw a strong recovery in demand from the region, although it was from a low base because 2014 was not good for us. Brazil remains a concern due to the economic environment there. APAC revenue was up 17%, reflecting continuing progress as we open this market to Wellington supermarket fan pack products. Europe was strong for us last year, but this year customer demand is down due to the economic challenges in the region. We've lost some business due to increased price competition, and we think some competitors are buying business, something we won't do. We expect to recover some of this lost revenue in 2016 with new products. Operating costs reduced from $4.2 million to $3.6 million. Some of our cost is denominated in US dollars, so the lower currency results in higher New Zealand dollar expenditure. So the underlying reduction is more than it appears. Employee wages and salaries reduced from $2.9 to $2.4 million. Gross margins improved again, 18.5% for the first half 2014, 20.7% this year. This was actually a disappointing outcome because of our negotiated pricing is for margins above 25%. It has taken longer than we expected for the lower supplier pricing to flow through inventory and into the result. Cash at 30 June was $3.4 million. Operating cash flows were positive, reflecting the reduction in working capital in the period. Inventory was $3.5 million, consistent with the position at 31 March and down from $5 million at the end of 2014. Inventory turns in the half were 3.1 times. We're now well into Q3, which is traditionally a low volume quarter due to Northern Hemisphere holidays and the intentional build-up of stocks by brands in Q2. Revenue in Q3 2014 was $3.8 million, and we expect to do a lot better than that this year. We said in the interim report that we will have an EBITDA loss in Q3, and this is still likely to be the case, but we expect the result to be an improvement on the $0.5 million EBITDA loss reported in Q3 2014. The seasonal patterns in our business mean that we won't hear from customers until well into Q4 on what they expect their demand to be. We still expect Q4 to be much better than last year. A break-even result for 2015 is probably unlikely at this stage, but we're confident that the EBITDA loss will be less than $1 million. Going into 2016, we will likely enjoy the full margin improvement from our Vietnam supplier from 1st of January, as well as the start of revenue from the new ECR2 and SCS controller products that are launching late in 2015. We also expect a lower average New Zealand dollar-US dollar exchange rate based on latest economic forecasts. However, this is always subject to change. Normal business risks driven by end market behaviour are still possible, such as timing of customer decisions on new product adoption, but we are in a positive position as we exit 2015. At this point, I'll hand the call over to Greg to talk about the progress on our strategic priorities and new products.
Thanks, Howard. Hi, everyone, and thanks for joining the call. Building scale in our business is our number one objective. And as I have said before, we won't do this with our legacy products, the ECR82 and ECR01. This can only be done with our new products and services, by diversifying revenues in new end markets and with new customer relationships, as well as working with our partners in sales, technology, and supply chain cost reduction. Our priorities this year were designed around building scale, which in turn will deliver profit performance we need over time. As a reminder, the priorities we talked about back in June were focused on a successful launch of the new SCS and ECR2 products, starting the development of the ECC frame product, continued cost reduction, and achieving EBITDA break-even or getting close to it in 2015. So here's how we're doing against those priorities. Our SCS Connect solution takes us in a brand new direction. It is a pure-play Internet of Things, hardware, software, and data platform designed for food and beverage retail brands. It gathers extensive data from the point of sale cooling equipment, turns that data into business improvement information for the customer through a Wellington-developed reporting tool, and makes it accessible in the cloud. It enables consumer beverage and food brands and retailers to connect with, track, and manage their point-of-sale assets more effectively and improve the performance of their equipment. It also gives them the ability to connect with the consumer through iBeacon and support merchandising initiatives. We are reinventing the company around this new offering and are making excellent progress in its completion and launch. Earlier this year, I've talked about the SCS trials we've had underway around the globe, and they're all continuing, and in fact, they're expanding. We have extensive trials with customers in Malaysia and Mexico, and have recently started one in Turkey. We also have a large number of inquiries for trials in the USA, Central America, and Germany. One of the learnings we've had is that customers need these trials to run for much longer, sometimes in excess of a year, in order to be sure of the robustness and effectiveness of the solution and to work out how to integrate into their operational and IT systems. We have learned a great deal from these extended trials and have built this into product hardware and software iterations over the last 3 to 6 months. Of course, the flip side of longer trials means time to revenue with some customers may be longer, but it also means we become more deeply integrated into our customers' systems. We are in advanced discussions with a major customer that we expect will lead to our SCS Connect product being adopted with this customer sometime in the fourth quarter or early in the first quarter 2016 for delivery through 2016. The discussions are complex and multi-level in nature and will take time to complete. So there is still some risk in the actual start date of this new customer program as a result of this complexity. We will, of course, update our shareholders as this progresses and when we have something more firm to talk about. Our customer diversification and supermarket customer development activities are also progressing well, with several new customer wins in China for our existing ECR01 motor fan pack solution, and, in fact, our first major brand name supermarket win in the UK. We have serious interest continuing in both Europe and the Americas for our ECR2 motor. We see 2016 as an important year for customers' expansion as we scale our new ECR2 motor with these customers. Since our interim release back in July, our ECR2 motor has obtained UL regulatory approval for the US market and VDE regulatory approval for the European market. We have built 2,000 motors as part of validating the manufacturing process and supplying customer pilot programs. Our first order for the ECR2 has been received from one of the largest US supermarket display case manufacturers, and they will be using this as part of their pilot trial program. This is a customer we have been working on for a number of years with our older products without success, and they are now seriously looking at the ECR2 due to its quietness, reliability, and efficiency. On the supply chain side, our cost reduction is proceeding well. In July, our strategic partner East West manufactured their 300,000th motor for us. So we are now purchasing from them at an improved volume pricing rate. We are also seeing supply chain cost improvement projects in our China and Malaysia-based supplier partners, such as moving more of our components to a turnkey supply strategy. All of this is helping lower our COGS, and coupled with lower commodity pricing that we are also seeing, we think we are on track to our 25% gross margin target. The one negative, as Howard mentioned in this area, is that we are around 2 quarters late on realizing the full volume pricing from East West as a result of slower inventory buy-downs, but this is now behind us. One of the new priorities I mentioned is our ECR C-frame. This was added earlier this year. We haven't progressed this priority much as we've decided to defocus on it for the balance of 2015 and put all our development and sales efforts into the ECR2 and SCS Connect. We will pick up the C-frame project again in the new year. So before I wrap up, let me talk a bit about how the year is looking and add a bit of color on next year. The extended time frame of trials for SCS and ECR2 mean we'll not see the scale of orders in 2015 that we originally thought, although progress and feedback from these trials means we are more confident than ever on the medium-term prospects of both platforms. Orders through the fourth quarter, of course, will determine how we finish 2015. And while I can't say at this point exactly where the year will end up, I can say that we expect volumes and in turn revenues to be up, gross margins to keep increasing, losses to be the lowest ever, and the closest to break even than ever, and of course for more orders on our new products. It certainly looks like we will deliver a big improvement in financial results, even without the help of FX. So it's all about our new products for the next 15 months, and with those in the market next year, coupled with steady demand for our existing products, we think we are still on the right track to make money. Okay, that's all right now. Over to you for questions, Eileen.
Thank you very much. Ladies and gentlemen, if you would like to ask a question today, please do so by pressing the star key, followed by the number 1 on your telephone keypad. If you are using a speakerphone, please ensure that your mute function is switched off to allow your signal to reach our equipment. Once again, that's star 1 on your telephone keypad to ask a question. And your first question comes from the line of Kevin Bennett from Harbour Asset Management. Please go ahead.
Hi, Greg. Can you just provide a bit more colour on Brazil? Because clearly, I mean, some of the stuff coming out at a macro level looks pretty horrendous.
Yeah, that's true, Kevin, and I think we're seeing that for sure in the demand levels out of Brazil, probably the lowest they've ever been for us. That said, Brazil as a region has 2 major customers. One, I think probably the 3rd largest cooler manufacturer in the beverage industry is based out of Brazil, and a very, very large beer brand, global beer brand. So we view both of those clients in that region as strategically important, so we're still keeping pretty close to them and supporting them with product. So, you know, how long the economic situation will last, I don't think we know, obviously, but we're just treating it very as a strategic imperative to keep close to those customers, support them the best we can, and they're both very strong customers, so we think they'll grow over time, not, outside of Brazil. They also have business outside of Brazil, of course, so that's really the focus on Brazil right now.
Right. And second, if I can, you mentioned pricing pressure coming through in Q3.
Yes.
Sort of where's that coming from? Is that out of your major European competitor, or is it third parties?
It's the region where it's impacting it the most, I think, is Europe right now. So we're seeing a little bit of that coming out of a Chinese competitor and also out of the major European competitor. Look, I wouldn't say what we're seeing is pervasive across every single customer. We've got a wide range of pricing, I think, in this market, a very wide range. So what happens is some customers get targeted on by our competitors and obviously by us, and, we tend to have to compete and go through a process with those specific customers. And I think in only one case over the last kind of 12 months, we've walked away for some business that we just felt like we weren't going to buy the business. But it's it's not across the whole customer base. It's not in every region. It's very customer specific where our competitors choose to behave this way. And sometimes we match them and play the same game, and sometimes we don't. It just depends on what our profit analysis is on that customer, Kevin.
Great. And finally, can we just have an update sort of how your relationship's going with your strategic shareholder in the States?
Very well, actually. I would say, we've got a supply chain strategy now that's been up and running for 18 months or so, where we've got 3 supply chain partners: our strategic partner in the States, East West, our Chinese motor manufacturer, and an electronics partner in Malaysia. And we kind of balance load between all 3 of those to support our customers. We're giving a decent amount of volume to East West right now, and they're responding with some very competitive pricing and some, I guess, visibility that they could actually improve that further through next year as long as volumes hold up. So the relationship's good. The commercial side of the relationship's good, and I think we're working closer than ever, not just on the supply chain, but also developing customers together in a couple of markets, the US being the main one.
Thanks.
Thanks, Kevin.
As a reminder, ladies and gentlemen, if you wish to ask a question today, please press star 1 on your telephone keypad. We have no further questions on the phone at this time.
Okay. Thank you, Eileen. So if there's no further questions, thank you everyone for joining. We are, like I said, well advanced on a number of the field trials and our new products, and we're pretty excited that we're on the cusp of launching these with some customers globally. So hopefully over the next 3 to 6 months, we can be talking to you again about how we're starting to scale our new products. So I look forward to our next call as well to talk about how we did in Q4 and the 2015 year. So have a good day, everyone, and thanks a lot.